Welcome to the Gray Report. I'm your host, Spencer Gray. And, if you're a multifamily investor, an aspiring investor, or, love the idea of creating passive income and generational wealth by investing through multifamily apartments, or you're just interested in the commercial real estate industry, well, you are in the right place, because we're doing another episode of the Gray Report, doing a Gray Capital newsletter, Gray Report newsletter recap, covering everything that happened in the multifamily industry, real estate in the economy, for the week of, it is the 1st of July, with the Independence Day, 4th of July weekend coming up, but really everything that happened this week, the last week of June. Again, we're going to be bringing in Dr. Matt Bosnagel of the Director of Communications and Marketing here at Gray Capital, bringing in his insights to what's going on in the multifamily industry. But first, just before we do, just a quick word from our sponsor. This week's episode of the Gray Report is sponsored by GrayReport.com, the premier multifamily intelligence aggregator, brought to you by Gray Capital. This will keep you up to date with all of the latest information and trends in the multifamily industry, real estate, and the economy, updated 24/7 throughout the day, really kind of bringing you the latest reports, articles, blogs, podcasts, and videos throughout the multifamily industry. So hop on over to GrayReport.com and check it out. This episode is also sponsored by the Gray Capital Investment Platform. If you are an accredited investor, hop on over to graycapitalllc.com. And, first, if you're not getting the newsletter, sign up for the weekly report. But then also, if you're interested in seeing potential investment opportunities from Gray Capital, why don't you hop on over and join the Gray Capital Investment Club? Again, if you're an accredited investor, this is a great way to view upcoming opportunities from Gray Capital. There's a short form for you to fill out. And then, if you'd like, you can pop on over and have an investment strategy session with a investment associate from Gray Capital. All right. So without further ado, let's bring Matt in. Matt, how are you doing today? And how are you doing this week? What's new?
It's getting hotter. I didn't think it could get hotter, but it does.
It is, I know. And that is part of the theme for this week's newsletter. I mean, record heat out there, I think on the East and West Coasts. It's been pretty, steamy here in the Midwest as well. I don't think we saw the record heat wave that they experience elsewhere. And again, so kind of the theme of this week's newsletter, are we heating up? Are we burning out? Are we getting too hot? Where are we, Matt?
Yeah. There's only so many ways of saying that the economy is as hot as the weather. But it's the same. It's the same story for the past few weeks. The jobs report was just released, and it shows fewer job claims. But again, there's rising prices, supply shortages, and consistent high demand that have made inflation hard to ignore. On the same day, you'll hear about wonderful stock market successes and growth investments, and then you'll also hear about movement away from riskier investments. In the multifamily and commercial real estate markets, actually, you also have this kind of elevated heart rate, so to speak. There's rising sales volumes, prices, activity, and there's this mix of anxiety about supply issues and the excitement that's looking forward to future success. The CRE markets have been less volatile and more deliberate, I think, in addressing this environment. But like in the markets as a whole, the blood is pumping fast, and we just want to make sure that things aren't going wrong.
Yeah.
And yeah.
I think there's a lot to be optimistic for, personally. And I think that, we kind of have to sit back and let some of this happen. And there's still things to work itself out. Like you mentioned, all these supply chain issues, a lot of that seems to be kind of easing off though. So that's really good news for not a, kind of seeing a really spike or potential for hyperinflation, which really has kind of been taken out of the conversation as of recent. So just quickly, we're going to do a quick snapshot of rates and markets. The 10-year Treasury yield, I'm still below that 1.5 mark, coming in at 1.49. The 30-day LIBOR coming in at 0.1%. SOFR coming in still basically near zero at 0.05%. But the spread between the 10-year Treasury and the 2-year Treasury, it's come down recently. It's a difference of 120 basis points. Now rates for HUD financing, HUD 223F loans, clocking in right around 2.35%, maybe like 5 basis points up from last week. The 221 D4s, it's coming in about 3.05%. Again, about 5 basis points increase, not nothing material. Fannie and Freddie right around that 3% mark. And again, for the agency loans, that was vary widely depending on what type of deal, what kind of sponsor you are, and the terms of the project. So, I would consult your own lender for the exact rates of where Fannie and Freddie are. S&P 500, broader stock market, still seeing record highs, 4,297 on the S&P 500. And the iShares residential ETF, ETF Res, $83.33. Spot price for gold coming in at $1,773 an ounce. Steel, it's come way down from where it had been previously in the year, clocking in at $1,766, perfect for the Independence Day weekend. Lumber, the Random Length futures coming in at $725. It's come way down from their highs. Crude oil still staying up there at $73.73. Bitcoin still hovering in that 30,000 mark at 34,358, and Ethereum has recovered much of the losses, coming in at $2,200. So we were seeing some, I think, more stability than we've seen in previous weeks. So that bodes well for the economy. That bodes well for the multifamily market as a whole. But Matt, I want to stay macro just for a second, because there was an article that came across the wire earlier this week. Eric Rosengren, the president of the Boston Fed, came out with a statement that the U.S. cannot afford another housing market boom and bust.
Yeah. Aside from the reference to home prices, and this is just from what I've noticed, this doesn't seem to be a new or different story from the Fed that we're seeing this week. But I do want to highlight a pattern that we've tracked for the past 3 weeks. There's concern about inflation. Someone from the Fed makes a statement, and things more or less proceed the same in the market, having been kind of reassured by the statement. I don't know if this pattern means anything. Is this meaningful? If the same thing happens in the next 3 weeks, will statements from the Fed carry less weight? Or is this some sort of signal that the Fed is coming closer to taking substantive action? I think the former. I think that the more they say it and nothing happens, it doesn't seem like things are going to happen. But I don't think you should bet against the Fed, and so it is interesting that this is the same thing that's happened for the
do not bet against the Fed. Do not take the counter position. You're gonna get destroyed every single time. And I think it's worth paying attention to what members of the Federal Reserve, Federal Open Market Committee, or board members, presidents of the Fed, what they have to say. But they can only say so much, and who really knows? And there's a lot of different opinions. I mean, if you look at Fed President Kaplan down at the Dallas Fed, I mean, he's very hawkish, and he's taking a lot of counter opinions than Jay Powell. To me, though, my takeaway is that this is another confirmation that the housing industry is too big to fail.
Yeah.
Too many individuals got hurt and are still recovering, and never recovered from 2008, 2009. And it was so detrimental to the economy, to society.
Yeah.
Not again. And so on one hand, they're concerned because they're pumping, we're buying billions of dollars, in mortgage-backed securities every single month, or the Fed is. Not to mention other types of debt. I think it's a total of like $140 billion in bonds they're buying every single month. I forget if it's 40 to 80 billion just mortgage-backed securities, which are mortgages for houses, for apartments. When the market really doesn't need that type of liquidity, it's basically pegging rates extremely low. And are we at risk for creating another bubble in housing? I think is the concern. But the reason they're doing this is because they didn't want the floor to fall underneath everyone during the coronavirus pandemic. So, I mean, they had made this decision long ago that, okay, we'll have forbearance programs. We don't want people to be evicted, the eviction moratorium. Basically, we don't want housing to be this strain on society. And so, but I think for investors, it cuts both ways. On one hand, okay, you're in an industry that the federal government doesn't want to see any kind of decline. And so you are working with the Fed, flowing with the Fed. They want to see this asset class sustain and grow over time. But on the other side, man, they admit that they don't know what's going to happen. And many times these boom cycles, the bust or the bubbles, they end up busting because actions taken by the Federal Reserve, whether that's too loose of credit and just inflating these asset bubbles to an unsustainable amount. But at the same time, you still have fundamental supply and demand issues. So it's not as though it's like it's and this is where it is different from the great financial crisis, where you had more homes than you needed. The demand was far below where supply actually was. And then you had rates rise, and the quality of borrowers were so poor that they couldn't afford these homes. They were so underwater. We're just in a totally different environment where we don't have enough houses. And the borrowers are qualified. They do have the money. They can afford to make these loans. And so just the fundamentals are a much more solid footing, but that doesn't mean that the Federal Reserve still can't come in and mess it all up for us. So I think it cuts both ways. One, can't let it crash, but we also have to be careful. We don't want to, by not wanting it to crash, we don't want to inflate it to a point where we're just totally out of sync with reality. So.
Yeah, it is interesting too, and I'm not sure if we covered this in another newsletter article or for previous weeks, but I've heard that home flippers are at a low point. There are less home flippers in the market now than there were before. So the demand is not coming from people that are trying to make a buck. This is just coming from people that want to upgrade their house or just it's just high demand for housing.
Yeah. So. It's interesting. I saw, this is again an anecdote, but on Reddit, I just track all the housing subreddits and just kind of what's going on. I know you do also. And there's a lot of people who don't want to sell to investors, just single family homeowners. They want to sell to people someone who's going to actually live in their home, and they don't want to sell it to someone who's going to rent it out, which I kind of get where they're coming from, because it's easy to say, investor bad, homeowner good. It doesn't really matter, because, okay, well, that investor could rent that house out, and there's a huge demand for someone renting, and maybe renting is going to actually help someone rather than forcing them to, cough up 60, 100 grand for a down payment to live there. You're actually helping the more well-off, than helping someone else that can't actually afford a home, but they really don't want to help out that investor, so they prefer to sell it to somebody else. So I thought that was interesting, and you never know, the flipper's going to be able to outcompete, or just those people, if they're living in a house, they don't care about like we've talked about, they don't care about the return. They just want to live there. So. And now, okay, so an article from Slate, 7 reasons to be extremely optimistic about the economy right now. I feel like we're just saying everything's good and rosy, but I mean, at the same time, you kind of have to, call a spade and be like, we are seeing we're in recovery mode right now. Yeah. We're in early phase. It appears we're in an early phase of a cycle. Some people say we're still in the last cycle. We're still in the bull market that started in 2009. Although technically we did have a bull market or a bear market last year. So, okay, 7 reasons. Matt, do you think there's 7 reasons to be extremely optimistic?
I think that this is an optimistic article. And just to fly through their reasoning, they say that because of the COVID declining, consumer spending, job openings, higher wages, recovering food service sector, and high productivity, and also inflation that might already be behind us. I think that that specter of inflation is more of a sword of Damocles than a distant memory, in my opinion. But I use this article, and then there's a following article that talks about the stock market in awe of the view ahead of it, that says that maybe even if we've reached a peak in recovery, the coming months and years may not be that bad. We're not going to be recovering as fast, or it might be as fast of a growth, but it'll still be okay. Now, those are 2 kind of rosier views. And then I would temper that really with this Financial Times piece that talks about this Goldilocks situation where central banks and durable high global growth, transitory inflation, and ever-friendly central banks are these three factors that combine to create this perfect Goldilocks, not too big, not too little situation as it pertains to growth and inflation. But I also think that his anticipation and his skepticism is captured well in this quote. And this just kind of sums up this whole section that I wanted to bring up. He says, quote, "The on-the-ground evidence of structural changes in supply at a time when aggregate demand will remain robust is kind of, I think that's the biggest factor, is there are structural changes in supply. We're still scrambling, trying to get back to work and plugging all the machines back in to start making things again, but there's high demand on top of it. So we're still building back the infrastructure, so to speak, to get everything from point A to B, to start making things. But the demand doesn't care about that. The demand is still just high. And I think that could really lead to inflation, especially I think too, with this labor, with the labor shortages. So.
Yeah. I think, Mohammed El Ararian, he has, I think, consistently some good takes, and he's been more in the camp that we're going to see more inflation than the Federal Reserve is saying that we're going to see. But he still doesn't think that, I think he has a quote down here, he basically saying it's going to be more elevated than the Fed's saying, but, here it is, to be clear, I do not expect return to the inflation of the 1970s. But we have to respect the possibility of a shock to this financial system that has been conditioned and wired for the persistence of lower and more stable inflation, which I think is a pretty good point that, things are going to run hotter for longer, but it's not the end of the world.
I really like this article. That's why I closed that. It was one of my favorite ones of this newsletter, because he talked about, I think it was really smart, and he made a story that's really compelling. We're just recovering, and demand and demand is outstripping our ability to meet it. So it only seems natural that prices are going to rise.
Yeah, I think so. Again, it's one of those things we're naturally skeptical, or at least, I am, and most investors are, of, always looking for that black swan of, what are we not seeing? But at the same time, you don't want to miss out an opportunity because you just can't find something that's wrong in the economy. I think you can probably make some bad decisions now, but I also think that not taking action could be considerably risky. I mean, we talked about this in the pandemic last year. Exactly. Yeah, there's a risk of investing while this is all going on. And we argued there is possibly an equal risk to missing out on the opportunity that we saw relatively clearly, certainly not certain of anything, but seeing again, all right, demand is here, supply is here, investor demand, apartment demand, what's going on the ground. We're not seeing everything just fall apart. We're seeing actually some great signs of growth. And fortunately, we were able to buy quite a bit of real estate last year at that everyone was looking for. Again, the COVID pricing, pandemic pricing and being lower. Well, the pricing was lower as it was flat. It was the 2019, 2020, early 2020 pricing that was low. It was it. And we're going to see that growth, and you just missed out if you didn't participate. Okay, so just quickly, Matt, just because it's dominated the headlines. It's an extremely tragic story of the condo collapse in Surfside, Florida. It's basically on Miami Beach. I was in Surfside a month and a half ago, 2 months ago. Well, I was in Bal Harbor, which is immediately north of Surfside. It's a really cute, quaint community. So it's, again, really sad. What are the implications, Matt? If any, do you think that from this?
I think that, first of all, even though we've spent a week, and there's been a week of fairly exhaustive coverage of this issue that I can't match, but this is a devastating event, and I think it deserves attention. I think in terms of what the reaction is going to be, I would probably place some attention on the local regulatory environment. I also think that it's important to look at the entire picture and not just assume that maybe just one thing went wrong. It could have been a combination of a lot of
Yeah.
factors, one of which it could be climate change or just the changing environment, not even global climate. It could have just been just the change in that specific local environment. And I haven't heard anything definitive about the construction, maintenance, or inspection of the building to lead me in any one direction. But I'm sure we'll hear more
Well,
about
wasn't
this in
there
the
some
coming
like
weeks.
there was some talk of maybe some like inspectors being like paid off or something at one point, and
Yeah,
like it like there were some like warning signs that I'm sure that like people saw but probably didn't take very seriously.
yeah, and like nothing definitive, and that's what I also wanted to avoid too. Is like people want to point a finger at
Yeah.
this, and I think the real tragedy is that it's probably not going to be a clear cut. There's not going to be a single enemy, and there's not going to be an easy solution out of it that's going to fix this for everyone.
Yeah.
It's a horrible event that happened, and I
Yeah.
feel for everyone that's involved.
Yeah, pretty freak incident. I mean, I think it'll probably, I think the media will continue to kind of link this to climate change and,
Yeah.
should we be building these coastal areas, which is a fine conversation to have. I'm not convinced that like that's what this was, though. I think this is more of maybe a construction maintenance issue, but we shall
And
see, and it's hard to speculate.
And speaking of local, and like I said before, there are many things that could affect the local environment. One of which is climate change, but other construction in the area. There are,
Yeah.
there are
That whole
local
area,
changes
there's all, I mean, it's high rise after high rise after high rise in
drainage
this narrow strip of beach.
Yeah.
Like, I'm not a construction expert for, oceanfront property. Maybe I should be at some point, but that's got to be tough. And yeah, and especially projects that were built, decades ago, and then all this new construction happens. But
yeah,
it's a lot of impact on a small little area. So I think
Changes
some
the way
good
water
points.
flows,
Yeah,
yeah.
exactly. I think you're making some good points that could be climate change. Could be. You just built. It could be local just to building right there too. So we don't know. We'll find out, and
Yeah.
we probably won't be covering it that closely. You can watch, CNN or wherever you want for the information on that. Okay, but Matt, let's get back to multifamily.
Yes.
Because apartment list, you sent this over to me, and I was like, oh man, we could do a whole video. Maybe we should do just a whole video on this report. Apartment list, they just are consistently putting out great data. But you're a little more read into it than I am, Matt. So kind of bring us through, kind of starting off with pandemic pricing is over, which we were just talking about.
Yeah, one of the things that always draws me into their monthly reports, which I should add, shows average rates at 9.2% above what they were at the beginning of 2021, which is worth noting in and of itself. I think the added bonus to these reports is that you get a lot of great data and visualization that they display through their graphs and maps.
Mm-hmm.
And one of the main points that they make in this report is about the slower recovery of gateway markets. And you can see a nice full picture in an interactive map that's part of this report, as well as several graphs that really track how the expensive markets, they're not snapping back as quickly as really the economy. If you look at retail over nationally, that snapped right back up. But the rents in more expensive, hard hit markets, they're sloping up a lot more gradually than than maybe was expected.
Yeah, which like we were talking about right before this is, that even with the base effect of the drop in the last year, the growth is still very muted compared to other markets that didn't see any decline and are growing leaps and bounds still. So and they mentioned Boise just continuing to crush it. But then I think what you mentioned, Matt, which I think is really cool. They have this apartment list city level rent estimates. And so these are so it's comparing year over year rent growth as well as month over month growth. And so and like to your point, these primary markets like in New York City, yeah, they saw 4.7% month over month rent growth. That's great to see, but they're still down 3% for the year, and they were already down. So they still have some room to go. And then out here on the coast as well, San Francisco, 10% decline year over year rent growth. But it's like those rents in San Francisco are so nuts. It's about time.
Yeah.
Same I think with probably Portland, but they haven't seen a decline. That's good. What we found interesting, and again, I talk to people all the time that are investing in, call it Texas, Georgia, and Florida, in these Sunbelt markets, which are awesome markets to invest in. Nothing bad to say, but more focusing on kind of what we're doing is that we're investing in these markets in the Midwest that have like the same growth fundamentals that these Sunbelt markets do, but like we're just getting so much better deals because everyone's like Sunbelt, 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 and because like, well, that's where all the growth is. That's where all of the growth is. Have you seen the metrics? I'm like, yeah, I have. It looks awesome. Everyone and their grandmother's heard about it and is flooding in and paying insanely low cap rates for this future growth when we're paying much higher cap rates for the same growth. And so, I mean, you can look at, Miami, Florida, maybe call this a primary market, 3% month over month rent growth, 11.5 year over year rent growth. Everyone's moving to Miami. When I was in Miami, like I was just mentioning, it seemed like everyone from New York had just moved down there. And then, look at, like a Carmel, Indiana, it's the same 13% year over year rent growth and, 3% month over month rent growth. Indianapolis, 7% year over year rent growth, 1.6% month over month. We've got really, it's very similar. I mean, Greenwood is 17%. It's hard to get my cursor on it, but 17% year over year rent growth, 3% month over month rent growth. And we're invested in all these markets. Lafayette, they got hit a little bit from the students leaving last year and the foreign students, but still, 7% year over year rent growth, 3.5% monthly rent growth. And then everyone's like, no, I want to go to Houston, man. I'm like, okay, cool. Houston, cool. 4% rent growth, but you're going to pay a 4 cap for it, but you're going to pay a 5 cap in Indy.
But you see though, even just in the aggregate, you can see that cluster of dark red in the lower right-hand corner of the US map. But then there are some there's some dark red up there. And if you go north, they're just fewer and more far between, but
Grand Rapids looks good. Yeah. Rochester, New York looks solid. Again, these are the secondary and tertiary markets that, that we mention all the time. I know that Arizona, Tucson is doing great. Phoenix, that's Chandler. Chandler's great too. Phoenix, again, 17%, 3.2. But again, Phoenix, people are flooding in, paying 3% cap rates in Phoenix. I can go to Greenwood, Indiana and get the same type of growth. You don't know about Greenwood, Indiana. That's fine. We hope it stays that way. Can we still keep getting these awesome deals? And we're still seeing, we're seeing people will say, okay, well, you're not going to get the appreciation because of the capital inflows. We still see capital inflows. It's just not insane. So, and as cash flow, and again, that's speculation. If you are a speculative investor, go for it. If you want a nice balance between appreciation and cash flow, that's what the Midwest, I believe, offers, is you get very strong cash flow, but then you get the cherry on top with the appreciation. Whereas if you go into these markets where you have severely suppressed cap rates, you're going to need someone to pay that same suppressed cap rate. So you need someone to pay that 3% cap rate, because I doubt they're not going to 2. Anything could happen. You need someone to pay a lower cap rate. You're very sensitive to any kind of movement in cap rates, but you're not going to get much cash flow at that rate. At least not for the first couple of years. But you got to move NOI. You got to move those rents significantly to start getting some cash flow. So again, we keep looking for the Southeast because we do see the growth. But then we keep coming back to the Midwest because it's the better balance. It's got the balance. So we could talk about the Midwest all day long. The Gray Report. Check out if you weren't signed up for the Gray Report newsletter, you missed out. Hop on over to grayreport.com. And is this on here, Matt, already?
Oh, yeah.
Okay. Oh yeah. So definitely check it out. Okay, Matt, what's next on the report?
Yeah. So just when it comes to capital markets and the supply chain, the story here tracks from the previous weeks. There's lots of available capital, even in the midst of supply and labor shortages. I did particularly like the report. It was quantifying market relationships with national cap rates. Now, it's a little bit heady, but I do think that there's like an evergreen element of this report. There's like some insights that will really serve people well. beyond this current environment. It's got some very compelling arguments and very compelling claims in here.
Yeah, I would recommend. I would recommend everybody read this report. It's really more of a study rather than whatever you want to call it. Really interesting because we're all trying to figure out where cap rate's going to go, and it's partially a fool's errand because we can't really predict them. Although they say make a really good point that it's essentially, it's really the trend is your friend, and what's the quote? The statement: yesterday's cap rate is the best indicator of today's cap rate. And they're saying that statement is empirically true. And so they're saying today's cap rate, I would assume that means that today's cap rate is also the best indicator of tomorrow's cap rate. So if today's cap rate is low, tomorrow's cap rate is going to be low. It's in a sense, it's a little bit kind of like technical analysis of like the trend is your friend, and like it's, lower, it's lower than lower than lower. Things can't go lower in one direction forever, though, I'd have to say. But they're really saying that's a much better indicator than looking at things like the 10-year treasury or any other kind of driver of cap rates. And they've listed the drivers of how correlated they are in order. And so this is very fascinating. They look at bond yields, they look at effective rent, and the big driver, just to sum it up for you, is effective rent. What kind of rents are you charging the property? It's not even net operating income, which is part of the formula for cap rate. What rent are you charging, and then what's the price per unit? What's the price per pound? That's driving things more than just this income approach, which I find interesting, and it's counter to a lot of the traditional real estate finance metrics that we look at. And I don't know if it's more now it's because we've just seen a market that's headed in one direction that's allowed people to make these kind of calls that aren't less using kind of the traditional metrics of, okay, well, when you're going to model something, let's model for every year, model 25 basis points of cap rate expansion. Well, you can do that, but the past 10 and 10 years of history would prove that to be incorrect way of modeling, and you will completely miss out on opportunities if you use that assumption, because what they're saying is all the information is showing what is most likely to be the case is cap rates will be moving in the same direction that they have in the past several periods. That means cap rates should be lower in the future rather than higher. But if you're only assuming that they're always going to be higher, you're making the wrong assumption. And I understand you're trying to make the more conservative assumption of, what if, and you have to do that, but are you missing the full picture and you're going to just erring on the side of caution? You're looking at it the wrong way. So, and I agree that it is a little bit of a heady piece. They really get granular with, kind of what interacts with cap rates to move them one direction or the other. And I think it's eye-opening for many people. So I recommend check this out. It's and honestly, it's a little counter. We did a video on correlation of cap rates and interest rates, and you can track it, and it's a good indication of this is the cost of debt. This is the cost of your income that you're buying at the property. But again, if you're doing a value add deal, a cap rate doesn't even matter because you're doing something to the project. So again, you have to be looking at these things in a dynamic way, and not just one metric. I'm only going to buy at this cap rate, and cap rates are always going to do something else. So,
yeah.
Okay. And then the National Association of Realtors, NAR, came out with another commercial market insight for June 2021. This is a pretty detailed report. We're not going to get into every aspect of it because they cover multiple asset classes. But Matt, I want to get your key takeaways. Again, it's very positive in terms of economic condition, but what's your what was your takeaway?
Yeah, I like these reports because it provides a decent snapshot. And I know these are based on a lot of the information is based on REITs. So it's not necessarily directly correlated with the CRE market, but it is but it is connected, and you can see some insights are pretty useful. You can see lower cap rates for multifamily properties, which I think is a sign of investor confidence and consistent investor confidence too.
Yeah.
Multifamily, as you can see in the trend line right there in the red, multifamily properties have been doing consistently well, and they're consistently improving. And also, I think when it comes to just the different markets, it's you scroll down to the industrial market, and it's nice to see Indianapolis as one of the top industrial markets. It's not in the other lists there for
Yeah, I was
multifamily or
surprised
office,
they
but
even
yeah.
included Indianapolis because I haven't seen Indianapolis on any of the NAR reports because they
Yeah.
typically just cover the primary and gateway markets. I think it's just because the metrics in Indianapolis are so huge. I don't want to season the market, but we've got a deal that's coming up. It's open for accredited investors. This isn't an offer to invest in anything, but that's really centered around a lot of this growing e-commerce logistics industry in Indianapolis.
Yeah.
And so it kind of makes sense. I mean, FedEx has their second largest hub in the world in Indianapolis. That doing $1.5 billion expansion. Amazon keeps opening major fulfillment centers. Apple's opening a 500 million distribution center. And I know some of the groups building a lot of these industrial warehouses for Amazon and the like, and they just keep knocking it out of the park. And the cap rate compression in the industrial market is just, it's been incredible over the last year. Way more than the multifamily market. And so, props to everybody doing the industrial thing. We've participated, come on the family office side, and as just passive investors in it. It's been, I think, industrial, multifamily, and medical office. That's kind of my two kind of favorite spots to be at right now in CRE. I like multifamily the best still, but all good stuff. Okay. Yep. And then, multifamily, you want to talk about the this Yardy report, Matt? Special report, lithium rent forecast update, maybe just briefly. I think
just briefly, it is worth it's worth mentioning that they noted a 0.88% rent increase, which is the largest on record. And again, it has
month over month, right?
Yeah, month over month. I'm sorry, yeah.
No. It's almost a 12. That's almost that's like almost 10% annualized. It's crazy.
Yeah, and it does track with the apartment list. Finding the 9.2 or 9.2% higher than the beginning of 2021. Also, again, is the difference between the gateway markets and smaller markets. Gateway markets have been slower to recover as a group, and I think it's perhaps becoming a long-term trend. I don't know how quick this bounce back is going to be, or when it's going to start to really fundamentally reshape the power of the gateway markets, where investors' money is going, and where the deals are going to be in the future.
Yeah. I think it's interesting. I'll belaboring the point, but it's pretty incredible the amount of rent growth that we're seeing. And also, the same point about Indy, and I don't want necessarily, it's a double-edged sword. More investors coming in, higher prices for our current projects, which is great, but buying new deals, we want a nice balance. We want just enough people coming in and joining the party here in the Midwest in Indianapolis. But how many times you heard someone say, I want to get into Raleigh-Durham, I want to get into Charlotte, I want to get into Houston, I want to get into Orlando, I want to get into Denver, I want to get into Austin, I want to get into, I'm just reading down the list of markets that have inferior growth metrics compared to Indianapolis. And, we're basically tied for Dallas.
Yeah, which is insane.
And just below suburban Atlanta.
Yeah.
I think we need to scrap this episode, Matt, because we're giving out like the secrets. Don't come to Indianapolis. Okay, well, here, how about this? This is what we'll do. join. If you join the Gray Capital, because the hard part is you got to know the right places to invest in Indy.
True.
There are places I would not invest 100%. There's a lot of apartments in a couple areas that I wouldn't invest, or I would not invest 2 blocks over, but I would invest on,
Yep.
1 block west. So, got to partner with the right group with the boots on the ground. And that's what we do. We're based out of Indianapolis. We look throughout the Midwest, throughout the Southeast. We keep coming back to our home market because we just can't find better deals elsewhere. And we know the market better than, I would say, just about anybody in the business, including a lot of folks in the Indianapolis market. And we, frankly, we're colleagues of all the best players in the Indy market. So hop on over to graycapitalllc.com and join that club. So it was cute. The plug was too queued up, man. I'm sorry.
No, that's fine.
I couldn't help myself.
Good segue.
But really, we're going into the 4th of July weekend. We're excited. We've got a couple projects that we're going to have under contract immediately here in the next couple of days. Got any plans? You doing anything, Matt, this weekend?
Oh,
you weren't ready for this question. You had
just like the Simpsons said, we've got to celebrate the building of our country by blowing up a small part of it. And I can only hope that it's safe and fun and loud. That's my plan.
I hope it's relatively safe. You don't want to be too safe. Otherwise you're not having enough fun. Yeah. No reward without any risk. That's what I would say.
Yeah.
So awesome, Matt. Well, I appreciate you being on today's show. Again, today's episode of The Gray Report is sponsored by GrayReport.com. Hop on over, www.grayreport.com, AOL keyword, Gray Report. So go check it out. We will be having, some really cool chat rooms, message boards, guest books, an Ask Jeeves widget we're going to put in. We're not doing any of that, actually. So actually, the chat room, I think, would be funny. The chat room would be good. And message board, I think we've got a lot of ideas for the Gray Report, in the future. We're kind of focused on running it kind of as is, keeping the most up-to-date information, and obviously everything else going on to Gray Capital. But I think the possibilities with the GrayReport.com are relatively endless for being, a really great platform for the multifamily industry. And so, Matt's done an incredible amount of great work for GrayReport.com. So thank you for that, Matt.
Oh, nope. I enjoy doing it. This is my favorite part of the week too.
Oh yeah, I know. Okay. All right. Thank you again for watching another episode of the Gray Report newsletter recap. I'm your host, Spencer Gray, president of Gray Capital LLC. Hope you have a great weekend, and we will catch you next week.